Harvard, BlackRock, and JP Morgan, also so many other banks are buying Bitcoin, trying to integrate their things into Bitcoin. And retail is selling. Retail is afraid of like the Bitcoin price going down at like 90K. That's crazy. And today's guest, Brian, is brilliant. And we analyzed why the smart money is now going all in to Bitcoin. We also analyzed the ETFs, how they opened the floodgate to Bitcoin, and how we will see the effects of that in 2026 and 2027. And also a fun topic with stablecoins, why stablecoins are actually a Trojan horse for Bitcoin adoption. Enjoy. We thought in the beginning of 2025, this will be a massive bull year, just like price-wise. And it just didn't happen from price perspective. But a lot of positive things have happened on the fundamentals side. And you were talking about like gold being a leading indicator, like liquidity being very strong now in 2026, and the fundamentals being as good as they have ever been. So it's kind of this weird concept where the underlying asset actually gets better and the price goes down, where you're like, yeah, this is the moment where you want to be in Bitcoin, not when it's the other way around. How have you seen the beginning setup of 2026 and also how you've lived through 2025?
Yeah, I mean, it really speaks to like that's where conviction matters, right? When the price is diverging from fundamentals, your fundamental thesis, that's when conviction in that thesis really matters. And that's frankly where a lot of people struggle. Short-term holders, people who have only been in Bitcoin for maybe a few years, they don't fully understand what they own. They get shaken out in times like Q4 of last year and even now. But reflecting on last year and sort of where we are today, I wrote a shareholder letter for OnRamp, company I work at, Bitcoin financial services firm. I wrote a shareholder letter earlier this week that went out, and it was sort of just reflecting on what happened. And I think you're right that expectations going into 2025 were super high. Everyone sort of expected this post-halving parabolic expansion in Q3, Q4 of last year. And Bitcoin didn't cooperate with people's sort of prophecies around cycles and these 4-year halving cycles that we've become accustomed to. And that caught a lot of people off guard. And, the other component too in 2025 was people were distracted, I would say, with whether it was the digital asset treasury companies or prediction markets. There were lots of distractions to say, basically you could make 100x in a month or two instead of just saving in Bitcoin. So that the allure of fast gains were there as a distraction. But fundamentally, things improved. Like in the broader landscape of a long-term thesis on Bitcoin, things are extremely constructive and positive. And I've kind of never been more bullish on Bitcoin in a sense that, you have the regulatory environment completely 180 flipped from where it was a couple of years ago, particularly in the United States. A very favorable administration that, if you look at a lot of these guys, whether it's Trump and his family, Bessent, Lutnick, a lot of these guys have personal vested interests in digital assets. And so, I think that's an important signpost to say this stuff is happening. Like even, on the stablecoin side, we had the passage of the Genius Act. And, I think stablecoins are like wildly bullish for Bitcoin. I think most Bitcoiners miss that because they get a little dogmatic about, anything that's not Bitcoin is evil and bad, and it's perpetuating fiat, which, I think is somewhat true. I think stablecoin proliferation allows fiat and the dollar to kick the can proverbially a little bit farther down the road. But in another sense, it's normalizing digital asset rails. And so once all of these banks and all of these incumbents, these fintechs build the rails for stablecoins, they are building the rails for Bitcoin. And it becomes known that you save in Bitcoin and you spend in dollars. And so I think that's the world we're headed to. And so you have that on the regulatory side. And then also, if you think about sort of the macro, the liquidity environment, people comparing this time frame, the price action to 21, 22, when we entered a bear market, the macro liquidity positioning is entirely inverse, right? We are coming off of a 2 to 3 year tightening period, the fastest interest rate hikes in U.S. history. And Bitcoin kind of chopped around for a few years, basically, particularly in gold terms. If you're looking at Bitcoin in terms of gold, not the U.S. dollar, we're kind of flat to down over the past couple of years. And so all of that is to say liquidity and the macro environment are shifting in the totally opposite direction now. Trump is wanting to lower interest rates. Powell's term is up in May, so he's going to be out. Trump's going to handpick someone who's going to lower interest rates for him. And they're ultimately going to inject more liquidity into the system because we know they have to, right? Like it comes back to just these very first principles sort of ideas around there's too much debt, not enough dollars. They have to monetize the debt. They have to debase the dollar. And I think the other super constructive thing from 2025 was a broader recognition of exactly that, right? We had the debasement trade sort of go mainstream. You had talking heads on MSNBC, whether it was Ray Dalio or others talking about the debasement trade. And I would say, it's not a trade. I wouldn't characterize what gold is doing as a trade. I think it's a structural shift in sort of the monetary order. And we know that because, again, the bid for gold is largely a sovereign bid. It's central banks accumulating gold. And so what that tells you is that there's less and less faith or trust in U.S. treasuries or any fiat currency. And so I would say 2025 was also a year of sort of broad trust erosion in institutions, right? Like even if you think about some of the fraud stuff that was uncovered in the U.S., like people are waking up to like the government doesn't know what it's doing. There's a ton of fraud and they just print money to paper over it. And so I think that narrative is super important. And, I think it makes sense also that gold is running first. Precious metals are running first before Bitcoin makes a real serious move that we're accustomed to in a quote unquote bull market. And that goes back to, again, the bid coming from sovereigns, from central banks. They're more familiar with gold. It's a more liquid asset to them. They can get in and out of it easier. And so it's logical that gold is moving first, but we should be very, I would say, excited about that in the sense that it's validating our thesis on the money being broken. So we are right, and we have a finite asset. Gold's not finite. They're going to keep mining more of it. They're going to keep finding more silver as well. And so people are going to wake up to a finite supply digital gold sooner or later. And so all of that is to say, 2025 was an interesting year, man. It was frustrating at times, but like I said, like I don't think the setup could be any better for Bitcoin right now.
I'm so like with gold being a leading indicator. It's not the first time that we covered it in the show. Literally just like 1 or 2 weeks ago, we had Stephen Perrinot on the show, like the Paul on analyzes all of the things, and he had I think 2 or 3 slides actually on that topic. He analyzed it from the very beginning of Bitcoin, and gold always had a leading indicator effect on Bitcoin, usually shorter than we have it right now. But I'm just like wondering like why gold is a leading indicator for Bitcoin. It's I don't know, it obviously happens, but it just does not make sense for me why gold is a leading indicator.
I would say there's a couple elements. The first is what I sort of alluded to around where the bid is actually coming from for gold. So it's sovereigns, it's central banks. I'd say individuals on the margin are buying gold, but it's really being driven by sovereigns and central banks. And so, we can believe in Bitcoin and know it's the best asset ever, but like central banks are used to gold. They're very familiar with gold, putting it in vaults and using it as a store of value. And so it's natural for them if they are sort of recognizing what's going on, even if you want to go back to 22 and the U.S. freezing Russia's treasury assets. I think that was kind of the match that lit a lot of this flame around the debasement trade and people recognizing that U.S. treasuries are not quote unquote risk free if they can just be seized if you do or say something wrong that the United States government doesn't like. And so that sort of kicked off, I would say, this global monetary reordering. Which we're still, I would say, in the early innings of, right? Like, gold's at nearly 5K right now. Like, over the coming 5 to 10 years, like I think gold could go magnitudes higher than 5K. And, the other sort of historical fact around gold being a leading indicator. I would liken it to, if you think about past Bitcoin bull runs where you have some sort of like distribution into farther out the risk curve, like alt season or whatever you want to call it. Like one asset runs and then it sort of distributes farther out the risk curve. I would say there's probably some component of that with gold historically running and then people moving out the risk curve in their minds to digital gold. But I would also say, like, I don't expect a huge like rotation out of gold into Bitcoin. I think the rotation is going to come from primarily bonds. Bonds are what's truly bleeding as a result of debasement. Getting paid a fixed nominal dollar yield just doesn't cut it anymore when we know monetary debasement is anywhere from 7 to 12% a year. So your 4% coupon is just not doing anything for you. You're actually losing purchasing power. So I would say the core rotation is not necessarily going to come from metals. I think metals are going to keep running. And I would say the rotation is more likely to come from the bond market or even the real estate market. Sort of these other asset class buckets that are in much more peril than gold, right? Like gold's in a pretty good spot right now. People are, the gold bugs have been validated to some extent. They've been looked at as crazy for like 30 years, if not longer. And their thesis around sound money is being validated in real time. I wrote a piece probably 2 years ago now. It was titled "The Sound Money Renaissance." Like I saw the very early stages of this post again that the freezing of Russia's treasuries, that there was going to be this renewed recognition or understanding that neutral hard assets are going to be very important going forward. Because if you can't trust U.S. treasuries, if you know that they have to debase these fiat currencies, you're going to need some other store of value outside of just government debt. And so the other massive thing from 2025 that I think most people have slept on is Harvard's endowment allocating to IBIT, BlackRock's Bitcoin ETF. That's a massive deal in my mind. Harvard is one of the largest university endowment in the world, typically very conservative, and sort of like known as like, the smartest people in the room, right? Like they are early to things, and they do extremely rigorous due diligence. And them allocating to Bitcoin, and not just allocating, like it is the largest single name position in their public portfolio, like bigger than, their Apple or their Google position. And interestingly, they also paired that allocation with gold. So GLD, the gold ETF, they did it in tandem. And that was very telling to me because it wasn't, what that tells you is like, they're not viewing Bitcoin as a speculative, levered NASDAQ tech play, as a lot of people on Wall Street still view it. No, they're viewing it alongside gold as sort of this like sound money allocation, this sound money sleeve, and having an analog and a digital form of sound money in their portfolio to protect themselves from the debasement that we know is been happening and going to likely accelerate into the future. And so that was a huge deal. And then you had people follow that lead. So you had Brown, Emory, I think Dartmouth this week disclosed IBIT exposure. And so that, zooming out a little bit, like I didn't even mention also like just the wild success of the Bitcoin ETFs. Again, like didn't necessarily show up in price, but I think absent those flows, the Bitcoin price would likely be a lot lower. So there was tremendous inflows into these products. They're, by all measures and accounts, like literally the most successful financial products ever launched, IBIT in particular. IBIT is also now the top revenue driver for BlackRock. It drives more revenue and profitability than their S&P 500 ETF, which is just crazy to say. And a couple of weeks ago, you had Morgan Stanley file for an ETF themselves, which was super fascinating to me in the respect that Morgan Stanley is not a massive ETF issuer or ETF factory, if you will. They have a few ETFs, I think around 20. Most of those are actually through sub-brands, so like a Calvert or a Parametric, where Morgan Stanley is technically the issuer, but they are sort of licensed out to these sub-brands. They actually, prior to the Bitcoin ETF that they filed for, there was only 2 other ETFs that actually had the Morgan Stanley brand name on the ETF product. And Bitcoin will be the 3rd ever. So I think what that tells us is like they saw the success of BlackRock's IBIT product, and they probably saw the client demand for it internally, right? Because they opened up access to clients to allocate to IBIT in particular. And so they probably saw a ton of flows internally go to IBIT, and they can only monetize that on the margins, right? With the sort of management fees that they charge their client on an aggregate basis on their portfolio. But they're not getting the 25 basis points that the issuer gets, that BlackRock is getting for all of that AUM. So they looked at that and they said, well, we have to get into the issuer game. There's clearly demand for this product. People want exposure to Bitcoin. Let's get into the issuer game. So I think that's a massive signal that, again, people are kind of ignoring a lot of the sort of banking and TradFi and fintech incumbent integration that's happening over the past 12 months. But like that is super constructive and supportive for basically opening up the real TAM of Bitcoin and who can get allocated and who can get exposure and who can be on Team Bitcoin effectively. And so I think all of that is super positive.
Yeah, JP Morgan surprises me every time because the CEO, Jamie Dimon, hates on it publicly so much, and clearly he cannot do anything. There's obviously a conspiracy theory of like he just hates on it to like keep the price low and all. I don't know if that's true. I don't try to speculate on like what his true intentions are with that. From all his public appearances, it feels like he actually doesn't like it. It seems like passionate dislike. But he is not a stupid person. So it's like it's possible that he like actually studies that and like actually understands what Bitcoin is. So I don't know like what his intentions are, but it's fun to see a huge bank where the CEO hates on it publicly, but at the same time, they do everything to integrate Bitcoin as good as possible. It's a weird combination, in my opinion.
Yeah, and I would go as far as to say, like, even like a Larry Fink, he's had a lot of good sound bites over the past year or two around Bitcoin and the merits of the value prop and the investment thesis. But I would say that these guys still don't necessarily understand Bitcoin at a deep level. I think they understand that they can make money from it by creating these products. And so that's what they're, I would say, primarily being driven by financial incentives of building these products because they know there's underlying client demand. Whether they themselves have personal allocations or truly believe in Bitcoin, I think is a different question. And I would err on the side of they don't really believe in it because they are so ingrained and have benefited from the fiat system that, there was a good clip from Davos this week that's going on right now where Brian Armstrong is on a stage with some central banker, I forget from where. And the central banker is like, the central banks are independent. They operate independently. And he said something to the effect of like, I don't trust the private issuers of Bitcoin. And you can see Brian Armstrong's face light up because he's like, all right, here's the dunk moment. I'm gonna inform you that there's no issuer of Bitcoin. It's a decentralized protocol. And it was a great clip from Brian. And Brian gets a lot of shit historically, and some of it's probably warranted, but he does have these moments where he has these nice sound bites.
I think it could be fun to watch a clip. Then let's watch the clip.
Governor, you have to address this. Is the euro in danger from a Bitcoin standard?
No, I'm a bit skeptical, Brian. Sorry to say it about this idea of the Bitcoin standard. We left the gold standard, but the gold was only a technical mean. What is important is what you say, Bert, that monetary policy and money is part of sovereignty. And we live in democracies, and I think the public role is key. And if we lose that, really you lose a key function of democracy. That said, I always keep repeating that money, as long as it exists for centuries, has been a public-private partnership. You need a public anchor, whatever its form is. Remember, and silver and gold were sovereign assets, so it was on the public side. And then you had banknotes, and you will have...
I want to just quickly jump in here with you because he just said that basically we need central banks for democracy. I so strong-heartedly disagree with that, but I want to get your take on that.
Yeah, I mean, it's what you would expect a central banker to say, right? Like my job needs to exist, right? So it always comes back to incentives. But as you and I both know, I think he even references like gold and silver were sovereign assets, and then he goes into like banknotes. It's like, well, you didn't necessarily need the banknotes on top of gold and silver, but yeah, these people are incentivized to talk their book effectively. Another way of saying it is. They need to perpetuate the fiat system. And so they're going to say it's necessary. They're going to say that they're independent and they can operate sort of truthfully and not be at the whims of the market. But in reality, like we just know that empirically that's not true. And we also know that like the end state or the end game, no fiat currency has ever survived. Like every fiat currency dies. Ray Dalio talks about this, and he's been sort of sounding the alarm on that for years. And I think he has some Bitcoin exposure, but probably much more gold exposure in his portfolio. But the end game is they need to print more. They need to debase the currency because they cannot have, basically, people like to talk about the AI productivity boom. There was another clip from, I think, Ken Griffin at Davos talking about, well, things are really bad right now. The debt's out of control, but hey, we've got this Hail Mary of AI productivity. And that's a fallacy for a couple of different reasons. The first is, the government, the central bank, cannot afford to have a super deflationary price spiral because it basically makes the debt that they've accumulated worth more. It's harder to pay back. So they're incentivized to debase the currency and make that debt easier to pay off in theory. So they really can't have a massive deflationary boom. So if that does come to fruition and AI starts displacing a ton of jobs, they're going to have to print a boatload of money, partly, in some form of like UBI, I would imagine, where, if millions of people lose their jobs and they can't put food on the table, there's going to be riots in the streets, first of all. And so there's going to be louder and louder cries for some form of UBI. They probably won't call it that, but, maybe they just send some stablecoins to your wallet, and this sort of paints a grim or a dark picture of this digital panopticon where digital ID becomes a thing. I think we're already seeing that in other parts of the world. So it's sort of a scary path, but I think that the central bankers have to talk their book. They have to say anything they can to perpetuate the fiat system. And so, Armstrong's rebuttal to that, I think, was great. It was perfect. It was cordial in the sense that, like, he characterized it as a healthy competition, Bitcoin, as sort of a check on these fiat central bankers. But that's charitable, I would say.
One thing that is also always bothering me when I hear central bankers, they say two things. They say they are public money, and they say that they're independent. And for me, public means you are controlled by a political layer. You are a public good, so you can be voted out. There's like some sense of democracy in that process. But that would eliminate that they're independent. Independent means like, then aren't you private if you're
Right.
independent from the public layer? So I never understand how they can claim both things at the same time, being public but then also independent. And then it's like, okay, from what are you independent? Does independent just mean you can do whatever you want? There's
I think that's exactly it. It's the cover. It's the air cover to be able to print money effectively and debase the currency. Is by claiming some form of independence. You can say, well, we're operating according to our mandate, which their mandate is oxymoronic in some sense, like price stability and targeting a 2% inflation rate. Well, that's not stable. 2% inflation over 50 years is like a 63% erosion of purchasing power. Most people don't realize that. People call compound interest the eighth wonder of the world, but people typically only think about compounding in the context of a number going up. But compounding cuts both ways, right? Like 2% compounded over 50 years is nearly a total erosion of your purchasing power. And so their mandate from the jump is nonsensical. And so I think they use the veil of independence as sort of a cover to say, well, we're sort of separate from the government. We're not really, working with them to tailor our decisions to what the economy needs. But I think what's happening currently in the U.S., I think you could look at it in a few different ways, where Trump is putting immense pressure on Powell, has been for, since he regained office. And I think they're trying, I think this is just, pure speculation, but I think Trump and Bessent are trying to remove that veil of independence because they want to have more control and more power and lower interest rates and basically, quote unquote, run it hot, as Bessent himself has described, meaning they're going to debase the currency. And they're trying to basically grow at all costs. And in order to do that, they need lower interest rates. And so I think this sort of battle that's happening in the public sphere between Trump and Powell, I think it's all purposeful in the sense that they want the American public and people around the world to recognize that independence was always kind of bullshit. And so the Treasury in particular should probably be able to exert more influence and control over monetary and fiscal policy. Because that's where they want to get to in order to sort of run it hot, like I said. So I think the independence thing has always been sort of a fallacy, and it worked for a while as a cover for central banks to do whatever they wanted. But I think what's happening now is sort of putting a pin in that to some extent.
The first thing that every Bitcoiner does, and the most important activity that every Bitcoiner keeps on doing, is buying Bitcoin. And I personally use Relai to buy and sometimes also spend or sell my Bitcoin. And there are two main reasons why I do so. The first one is it's Bitcoin only. They do not do any shit coins. They do not do any cryptos, any stocks, or anything else. This is a tool, an app that is fully focused only and solely on Bitcoin. The second one is self-custody. They give you the keys to your Bitcoin the moment you buy them. You never give them the control over your Bitcoin, and you don't have to trust them because you can verify that you and only you have the keys to your Bitcoin. There's no third-party risk. There's no freezing of your assets. There's no rug pulling. There's nothing of that. Download Relai, the app, on your phone, or go to relay.app on your browser and use code Robin to save fees and get cheaper Bitcoin. I want to tell you about something very special to me. It's called Microseed. If you hold your Bitcoin in self-custody, and you should, you know how critical it is to secure your seed phrase. You should not have them on paper. You should not have them on anything else than titanium. With Microseed, you can engrave your 12 or 24 word seed phrase, the entire seed phrase, onto a 1-inch small washer. Yes, just one washer. All 24 words on that one washer. You can hide that thing everywhere. And even better, you don't need to buy a new kit every time you have to get a new wallet. You can make unlimited backups because Microseed is not selling the washer. Microseed is selling the device that stamps the washer. So you get the full kit with the device, with the washers, with the hammer, with everything you need to get started today, and you can make with that unlimited amount of backups. Go now to microseed.io. And actually, I find it a lot more honest because if you have to fight Jerome Powell and Trump, one is at least voted for.
Good point.
One is at least selected by a lot of people to run the thing. Now you can think about him whatever you want, but at least a lot of people voted for him. Nobody voted for Jerome Powell, and then Jerome Powell should be there for the people and independent and public and all of that. It's, I don't know. It's just make it a thing that it's actually from the government, and it's it's backed by the government. It's what does the US dollar be backed by? US military. but like, aren't they like independent? Like all of that is like the deeper you look, you like that all does not make sense. It just like all does not match up. It's just like putting nice words in there so people don't get it. But yeah, maybe let's watch the rest of the clip. I think there's like a minute left or something like that.
CBDC. But anyway, the most important part of payments is in the private sphere, and this is the development of tokenized private money. But this tokenized private money must be regulated to inspire trust, confidence.
It's fascinating that you say that. Brian, you mentioned a complementary role that you could play.
So I think that crypto is very good for fiat currencies. It's very good. Bitcoin is like good as a check and balance on deficit spending, because when there is a lack of trust, or people, from like in a U.S. context, if people are worried about inflation, or maybe in places like Argentina or Turkey or Nigeria, they are going to flee to the thing that they believe is going to store value more. So I think in general it's going to be very complementary, and like you said, I think it comes down to trust. And so if fiat currencies can maintain trust and not have the money printer kind of debasing everybody, then they'll survive. But if countries that have bad behavior on that dimension, Bitcoin doesn't have a money printer. The supply is fixed, and people will go to it in times of uncertainty, kind of like they did with gold.
The guarantee for trust is independence on central bank side. And we have a core mandate, and we are accountable to that. But sorry to say that I trust more independent central banks with a democratic mandate than private issuers of Bitcoin, which have a very useful role. But
Bitcoin is the decentralized protocol. There's actually no issuer of it. So that's in the sense that central banks have independence. Bitcoin is even more independent. There's no country or company or individual who controls it in the world. And so anyway, I think it's a healthy competition, because if people can decide which one they trust more, and I think it's actually the greatest accountability mechanism on deficit spending.
Bill?
I love those points. I didn't see the clip before, but it's a really like a strong one. Brian Armstrong probably gets a lot of shit from a lot of the Bitcoiners, but I think he might be undervalued as a proponent for Bitcoin in the political sphere. I think he did a lot of work behind the scenes that, of course, benefited his company and benefited himself and all of that, but also benefited Bitcoin. But yeah, it was a really it was a crazy clip. How do you think about the rest of the clip, and also like Brian Armstrong as like a lobbyist for Bitcoin in Washington?
Yeah, I think it's interesting, right? I think he himself has gone through an evolution of sorts. When he first started the business, it was a Bitcoin business because there weren't a ton of altcoins. And he decided to, at some point, 2015, 2016, 17, sort of pivot the business to service the entire digital asset crypto market. And in some sense, like that makes sense, because it was very hard to build a super successful business on Bitcoin alone as these other things started proliferating. And being an exchange as their like core product offering, it behooved them to offer other assets to trade, because that's how they make money. They make money from trading revenue and effectively pushing people out the risk curve to these other assets. But I would say within the past couple of years, he has kind of had a come back to Bitcoin type of moment where, they started stacking Bitcoin on the balance sheet, which they hadn't done for a long time in the history of the business. And they started building more Bitcoin specific products even. And so I think he has had a bit of a change of heart, or at least a recognition that Bitcoin kind of is still and will continue to be the dominant force in the sort of crypto sphere. And it's probably too late for him to fully pivot away from the casino that he runs on the side. But I think you're right in that he does have these sound bites from time to time. And Coinbase has spent a ton of money to lobby in DC. And I would say you could counter that and say, part of what they've been lobbying for is the broader crypto industry, not necessarily Bitcoin. So there's a couple different ways to look at that. But I would say by and large, they've been a net positive for Bitcoin, and particularly within the last couple of years, because, what they're up against is the bank lobbies, which have a ton more money. And so you kind of need these well-capitalized proponents to be in DC and try to sort of tilt the ship in the right direction in terms of the regulatory frameworks that are being proposed. Now, it's very interesting with the Clarity Act, which is sort of ongoing debate around this market structure bill that's been drafted for a couple of years now, and there's sort of debate back and forth. Coinbase actually sort of pulled support from the bill last week after there was some debate and discussion. There's a few hot button issues in the bill. And probably the main one is around stablecoins and the ability for stablecoin issuers to provide yield to holders of the coin. And so with Genius passing last year, there was basically this workaround or this loophole that Coinbase was afforded where they have a partnership and an ownership stake in Circle, the issuer of USDC. And while Genius states that USDC and Circle themselves could not issue yield to holders of the stablecoin, in exchange could. So that's basically the current working loophole, is that Coinbase can offer yield on USDC because they are not the technical issuer of it. Now, the banks don't like that for a lot of reasons, but mainly they are scared of deposit flight. So if you can earn 4%, whatever the U.S. Treasury rate is, just by holding a stablecoin in a wallet, then that severely impacts the appetite for people holding dollars with banks effectively and earning some marginal yield. So that's what they are actively lobbying against. And the fear, I think, on Coinbase's side is that they're lobbying so hard against it that they're going to remove that loophole effectively. Now, there's been some discussion around sort of negotiations or compromises where the quote unquote yield would not be tied necessarily just to holding the coin. You would have to do some action with it, whether it's like trading or staking or encumbering it in some way to earn a reward or a yield. So it remains to be seen how that's going to shake out. But, I think there's a lot of different interests, and why people are struggling with like, okay, is this good or bad for Bitcoin, is because no one even knows really what's going to end up in the bill. So you have different factions that believe certain things are going to end up in this bill. And so it could be either positive or negative for Bitcoin. And then, the other hot button issue in there is all the stuff around self-custody and self-hosted wallets and money transmission. So there's a lot of unanswered questions in that bill, but I do think it's at a high level important because it's sort of similar to like when the ETFs went live. Like it is an important green light for a lot of people who are currently not allocated to Bitcoin, particularly in the institutional realm, to get comfortable and feel that there's real robust regulatory frameworks to allocate to these assets, because ultimately a lot of those people in the institutional world, they're fiduciaries, right? It's not their money. They have underlying clients that they're managing money for. And so those sort of regulatory green lights are very important for them. So I do think the Clarity Act is important. I don't know if it gets passed this year. I don't know what the end state of it ends up looking like. But it was interesting to see Coinbase basically say last week, like, no bill is better than a bad bill in their minds. And that was a direct quote from Armstrong in sort of characterizing why they pulled their support. So yeah, a lot of unanswered questions on that side. But I think, to the original point, like I do think it's important that, we do have people in DC lobbying for these things. I look at the work of the Bitcoin Policy Institute, for example, have done fantastic work in that regard, more so on the education front, talking with politicians, getting them down to deeply understand what Bitcoin is and what it represents and how it can be accretive to America at large, right? Like, I think that's the other sort of unspoken, super bullish component of this administration, the amount of interest and appetite that they have for this asset class. That is going to be super important going forward because it just gets more people comfortable with allocating to these things. So I think it's super constructive, but it remains to be seen on specifically the Clarity Act, how that shakes out.
I'm also interested in because you mentioned stablecoins previously in the beginning, briefly, and I'm thinking so much on like, what is the role of stablecoins in the coming years? And I have a feeling that they will become a lot more important in the next like 5 to 10 years, and then long term completely fade out. But like very, very long term. So I think they have, like in the medium term, in the short term, a very big role to play, and might even be like the slow and gradual shift towards Bitcoin in the long run. We might actually look back at them as the bridge between the fiat currencies as we knew it to the Bitcoin ecosystem that we are building. Is that kind of like a fair way of like kind of seeing them as like a bridge between those two systems, that obviously we can't switch from one day after the other day?
Yeah, I think that's totally fair, and that I would agree that is sort of the trajectory. You know, every bank is looking how to integrate stablecoins. Every fintech is looking how to integrate stablecoins, and I think why it's important and relevant to Bitcoin specifically is because it normalizes these things. It normalizes digital assets broadly. It normalizes wallets and private keys, and basically puts these things into the zeitgeist as practical, usable, efficient, cheaper than traditional fiat rails, faster, et cetera. So there's going to be basically this learning process of, inserting stablecoins into people's everyday lives. And then it becomes very easy to basically put, in your brokerage account or in a wallet app, your Bitcoin right next to your dollars. And then it becomes the sort of like mental model or framework is, you save in BTC and you spend your dollars if you have to. The other interesting component here is like Paolo from Tether gave a very interesting talk at some conference in sort of the middle of last year, where he was basically talking about more of that end state, the longer term sort of playing field for stablecoins, where, if you look at what Tether's done over the past few years, they've been obviously buying a ton of U.S. treasuries, but they've also been buying Bitcoin and gold and real estate. And the vision that he sort of paints is like, yes, stable coins are going to persist for some intermediate period here, but what ultimately is going to play out is game theory around, well, what's actually backing the stable coin? Because if what we know to be true around the debt, the deficit, the debasement that's going to occur, and even like interest rates getting ramped down, those yields on stablecoins are going to look less and less attractive in that world, right? Like if the interest rate is 2% and monetary debasement and inflation is like 10%, like that's not super attractive necessarily. And so, basically, I think what Tether is positioning for is like effectively switching out that collateral at some point, where it's no longer backed by U.S. treasuries, but your U.S. dollar stablecoin is actually backed by some combination of treasuries, gold, and Bitcoin. And then what that'll allow them to do is pay a more attractive nominal yield because they're actually using collateral that's appreciating in dollar terms as opposed to U.S. treasuries, which are eroding in purchasing power. So I think that I think you're right in that, there's going to be this interim period where stablecoins proliferate. It allows the U.S. government to extend dollar dominance around the world, continue to sort of kick the can. But ultimately, what's backing these stablecoins is what's going to become critically important. And I think that shifts sort of over the longer term trajectory.
This is really interesting. I'm watching now more and more the debate around stretch and strategy, where it's like if you engineer some digital product that comes around with Bitcoin and you assume Bitcoin goes up by 20% or 15%, which I think is conservative over the next 10 years, then you can like offer like 11% yield on that and still make the difference for yourself. And obviously not everyone can do that, but play a strategy with huge capital pools, with the credit rating and like all the things that they have going for them, and like over 700,000 Bitcoin now. It almost seems like normal bank accounts, even if they pay you 3-4%. I mean, in Europe they pay you like 0.4%. If you're lucky. This is like, why would you even go for anything else than that? Like the whole ecosystem shifts to Bitcoin, and now, like Stretch is not Bitcoin, like definitely, but it is issued by a company that is a Bitcoin company to a certain degree. It is a product that is backed by Bitcoin to a certain degree. And so of course, this is better than having it on like your 3% bank account or even like a USD thing. And it's like all those small things that are coming out, I'm like, all of it will shift to Bitcoin. And then we at some point live in a world where Bitcoin is just the underlying financial industry, the underlying financial like rails that have everything, and then on top of it, people will like issue things on there, like make digital things around it, and like make financial services and whatever comes on top of it. Then it's like hard for me to like imagine what the world exactly looks like. But we're moving in a very fast pace already to this world where everything is kind of like Bitcoin is the foundation, and you can put your thing on top of it. The most important thing for your Bitcoin journey is not buying Bitcoin, but it's how to keep them. And yes, you have maybe the right tools, but how do you actually go ahead and stick it all together so it's the most secure for you personally? Self-custody is a deeply personalized journey, and the Bitcoin way is helping you exactly finding that correct setup for you personally. They are also helping you with securing your own cybersecurity. And if you want to go one step above all that, you can even get a consultation for a Plan B residency. Go to thebitcoinway.com/Robin and you will get a 30-minute free consultation. I finally and officially mine Bitcoin. This is not just something to stack more Satoshis, but it's most importantly also to support the network. Individual miners are the ones that keep the Bitcoin network decentralized. And by the way, you get KYC-free Bitcoin. That's why I use Simple Mining. I get an actual proper Bitcoin miner. They set it up for me. They repair it if it breaks down. And most importantly, they let me choose the pool and even connect my own full node. I'm completely sovereign and I'm completely in control, and I can sign up with Ocean, no account needed. I just give them a Bitcoin address and then there's mining going on. No KYC, nothing. So if you're ready to mine Bitcoin, go to simplemining.io, tell them you come from Robin, and let's mine Bitcoin together.
Yeah, another way of saying that is like Bitcoin is becoming the base collateral, right? And so you can put any sort of fiat-linked credit instruments on top of it and likely pay a better yield than just something that is purely fiat credit-based. So yes, I do think that that's where we're headed. I think MSTR's products are interesting. They've effectively evolved into a fixed income shop to a certain extent. And I think that that's, going back to sort of like reflecting on 2025, I think that's what was lost on a lot of people when, a lot of people tried to imitate what Saylor's done. And I think, probably didn't give him enough credit for what he had built. One, just being super early and building such a large position that he could create these other fixed income like products. It's very hard for someone to stand that up just by spinning out a SPAC shell company and trying to imitate it. So I think that led to a lot of capital destruction in these markets. But I do think it's fascinating from sort of a financial engineering perspective, and something that we're going to see more of. To your point, like I even look at something like River's product they launched last year, where you have basically a cash account that's earning a 3% or so yield, but that yield is being paid in BTC terms. Like stuff like that, I think is going to proliferate, and we're going to see a lot more things like that. Where again, it gets back to that mental model of you can spend or even borrow in dollars, but ultimately the collateral and what you're storing long-term value in is the BTC. And so there's going to be all different sort of machinations and products that allow you to basically follow through with that mental model and line of thinking. But that's kind of where we're headed. So back to the original point, like that's why stablecoins are super bullish for Bitcoin, even though on the face of it, it doesn't feel like that. But they are super constructive for Bitcoin adoption longer term.
Yeah, I think we have to, and this comes from someone that's like purely like Bitcoin only self-custody, but I think we have to go away from this. If it's not Bitcoin, it's evil.
Yeah,
like there's like those like dogmatic, toxic thinking of, okay, if you don't have Bitcoin and self-custody, multi-jurisdictional, multi this and that, then everything else is evil, and we should not touch it at all, and we shouldn't even think about it. But there is a real world use case for having maybe a US dollar reserve for your own family or a company. There's a real use case for maybe playing around with stable coins and paying people in stable coins also here and there, or for strategy in your portfolio. Like those things might just make sense for an individual. I agree, like most of it should be in Bitcoin and self-custody, coming from someone that has 98 or 97% of his wealth in Bitcoin in self-custody. But especially on Twitter, it's like you mention anything else, you're like, oh, you're a bad actor.
Yeah, no, I mean, I totally agree. And I think, it was interesting to see Square or Block, I should say, turn on basically Bitcoin on across all their POS terminals. But also what they did was they turned on stablecoins and they're using Solana. And so I think that is very reflective of exactly what you described, in the sense that it doesn't behoove Bitcoiners, us as an industry, to be super dogmatic about these things, because there are practical realities of effectively what is commercially viable, what do people actually want to use. And the reality on the ground is most people would rather, the average merchant would rather accept a US dollar stablecoin than Bitcoin. And so I think giving people the ability to do both is super important. And it doesn't, like I said, it doesn't behoove us to be super dogmatic about these things. And, even on the custody side, OnRamp, our business, we've caught flack historically for, being a different solution in the market, right? It's not pure self-custody, but you have much more control than just putting your Bitcoin in an ETF, for example. It's sort of a hybrid approach, right? You're using native multisig, you have a segregated vault that is legally titled to you, and you're sort of quarterbacking that multisig quorum, where none of the institutions in that quorum, 2 of 3 quorum, none of those institutions have unilateral control, because they all just have one key. So the end client ends up retaining some amount of control, even though they're not managing private key material themselves. And so historically, we've gotten pushback from the super dogmatic folks on Twitter or wherever it may be, that, this is, somehow bad for Bitcoin. When in reality, it's I think we're just providing an alternative that can be accretive to your self-custody setup. Maybe you want an inheritance plan. Maybe you want to take out a loan against your Bitcoin. You want to access financial services. Well, you can do that all within OnRamp and still maintain that element of control, where you can always withdraw it to self-custody. You have 24/7 auditability on chain. You can see your vault. So that's very different than ETF price exposure, right? You don't actually own Bitcoin. So, I think there's sort of two sides of this, right? Because Bitcoiners are very excited about the ETFs, the capital inflows, the opening up of the access to these other pools of capital that want to get exposure. But at the same time, there is a real risk of concentration at the sub-custodians, right? Because 9 out of the 11 ETFs in the US just use Coinbase. They outsource it to Coinbase. And so there's a real concentration risk at Coinbase. And this comes from someone, I worked at Coinbase for a year prior to joining OnRamp a few years ago. And, there's a lot of great people that work there, and they've done a really good job of securing assets over the years, and they haven't had a real catastrophic failure of any kind. But the reality is, any single entity is fallible. We have to assume that any single entity is fallible. There was an example last year of that big Bybit hack. I think it was over $1 billion hacked out of a multisig wallet. It's well, great. They were using multisig, but the problem is that, all of the keys in the multisig were in one institution, and that institution got compromised. And so the multisig didn't end up mattering. And so that's why our view is you need to actually disintermediate the keys themselves and have basically a separation of powers, where there's a natural sort of game theoretical check and balance, where if you only have one key in a 2 of 3 quorum, you can't exert control or influence. You can't unilaterally move or lose the funds. So, on the note of sort of the dogmatic nature of Bitcoiners and sort of our sphere historically, I think one of the big things that people miss is people are excited about all of these inflows to the ETF products, opening up access and sort of the total addressable market of people that can get exposure to Bitcoin. But what's less talked about is the sort of severe and increasing concentration risk at Coinbase, right? Coinbase is the custodian for 9 out of the 11 of the ETFs. And so there's a lot of Bitcoin that is being amassed by Coinbase right now. And this comes from someone myself who worked at Coinbase for a time before joining OnRamp. And so, I know that there's good people there, and they haven't had sort of a catastrophic hack or loss of sorts. But that is not to say that any institution is sort of infallible. And so, what we focus on at OnRamp is what we call multi-institution custody. And really, it's meant to be, an accretive solution. So it's not meant necessarily to fully replace your self-custody setup. We think that there are advantages to having basically access to financial services. So whether it's taking out a loan, setting up an inheritance plan, trust structures, what have you, it can be helpful to have some amount of Bitcoin in multi-institution vault to be able to access those things. And in our view, it's much preferable to just allowing a lot of these coins to flow into the ETFs, because ultimately you have single entity risk there. About a year ago now, there was a large hack of the Bybit exchange, and they were using multisig, but ultimately the entity itself, the company Bybit, was compromised. So the fact that they were using multisig didn't end up mattering. And so, in our view, what's critically important is actually distributing the key material to distinct entities. And so that's what we do at OnRamp. We create a 2 of 3 multisig vault where OnRamp only holds one key, and then we have other custodians in that quorum that each hold a key. And so the end result of that is that none of the institutions have unilateral control to move or lose the assets. And it allows the end client to remain somewhat in control in the sense that they quarterback that quorum. And so nothing can move without their explicit direction. And the end client has legal agreements with all of the key holders in the quorum that they will act on their behalf effectively. And so we think it's an elegant design surface that is much preferable to allowing a lot of coins to just centralize in Coinbase's coffers in these ETFs, because ultimately that's how gold failed, right? Like, gold was sound money. Ultimately, it got centralized in bank vaults, and then it was rehypothecated to some extent. And I could see the same type of thing happening if we allow a lot of the Bitcoin to sit with a few different institutions, whether it's Coinbase or others. And so this design surface of multi-institution custody allows us to basically avoid that or prevent that, where, as in a multi-sig vault, the Bitcoin's kind of everywhere and nowhere. And so you can do very interesting things with this design surface, where maybe you want key holders, each of your key holders in a different jurisdiction. So we have a lot of clients and prospective clients who worry about, the proverbial 6102 risk of the government, saying, tapping a custodian on the shoulder and saying, hey, all those Bitcoin are now ours. It's much easier for them to do that with Coinbase, as opposed to a multi-sig quorum where you have one key holder in America, you have one in Singapore, and one in Dubai. The coordination that would be needed at the government level to basically freeze or seize those Bitcoins it just adds a layer of friction, right? And that layer of friction could be all you need to withdraw from OnRamp and hold those coins in self-custody if you think there's a real risk of the U.S. government doing something nefarious like that. And so it gives you a buffer effectively. And so there's a lot of interesting things that we can dive deeper more on our model and what we provide. But I do think it goes back to the point that we started this question on around just like the dogmatic nature. I think Bitcoiners need to be a little bit more open-minded around different products and solutions, meeting the market where they're at. Goes back to the stablecoins thing. It's like people want to use and spend dollars. People want to accept dollars. Not everyone's comfortable receiving Bitcoin just yet. So, you have the Squares of the world turning on stablecoins. I think you're going to see that ultimately from other Bitcoin companies as well, because it's the reality of what customers and consumers want. They want to be able to spend dollars and save in Bitcoin. And that's, like I said, kind of the world I think we're headed to.
Yeah, Coinbase is a crazy honeypot.
Right.
Like they have a lot of Bitcoin.
The ROI on attacking Coinbase only goes up the more coins they accumulate. That's the other big thing that people miss is like, okay, ETFs are great, super successful. The more and more coins they have, it's just a bigger and bigger target on Coinbase to be attacked and try to be compromised. So, yeah.
100%. It's crazy because like people look at strategy as like a honeypot, but then they're like, yeah, Coinbase has a lot more coins. I like Coinbase, the company does not hold more coins, but they hold a lot more coins for their customers, which in the end, that's what what
And
they
they
want.
hold some of Strategy's coins, if I'm not mistaken. Like Strategy just basically splits. They diversify their custodians. I think they have some at Fidelity and they have some at Coinbase, maybe Anchorage. I'm not sure. But that's been the best practice, right? If you think about a lot of the public miners, right, who hold a lot of Bitcoin, the sort of best solution that they've come to is diversifying across separate custodians. So say they have 5 different custodians. If one of them goes down, they only lose 20% of their Bitcoin. What our model and multi-institution presents as a value prop is if one of the custodians in the quorum goes down, you lose 0% of your assets, right? Like that's the true sort of redundant, fault-tolerant nature of an MiC quorum, is that you can have something go wrong and still not lose any of your assets. And historically, that has been impossible in Bitcoin. You've just had to basically spread it out and hope that nothing happens. So I think we're going to move to a world where people recognize that there's a better architecture for basically creating a more fault-tolerant Bitcoin custody setup.
100%. One last topic I want to get into is the media exchange side of things. I'm really big on driving that innovation forward, even if it's not reality now, and even if the incentive structure is not in favor of that. You're incentivized to spend your US dollar, to just use your local fiat currency. Many reasons like taxes, like it's the weaker currency, like all of those things. How do you see the medium of exchange developing for Bitcoin in the coming years, maybe even decades?
Yeah, I think it's going to be a longer journey than most Bitcoiners probably expect. And the main reason for that is that I think there's a ton of appreciation, ahead of us in terms of Bitcoin's dollar price. And so, to your point, the incentives are not necessarily to spend your Bitcoin; they're to save your Bitcoin and spend in dollars, even borrow against the Bitcoin in dollars and spend those dollars. And so, I think the other thing that we talked about a ton is like stablecoins. So I think stablecoins do cut into the idea of Bitcoin being a medium of exchange, at least in the near term, right? Like if you can basically have these digital rails where you can swap in and out of dollars and BTC, you're probably more likely to just spend dollars and continue to save in BTC as opposed to spend the BTC. And so where I think the real transition starts to happen is when, and Parker Lewis has talked a lot about this, so I'll shout him out as sort of, pioneering this idea, is that it's really going to come from not people wanting to pay in Bitcoin. It's going to come from people wanting to accept Bitcoin, where they get to the point where they no longer want your dollars. And that could take a while, right? Like I think we need a little bit more blatant inflation. Like we've got, fits and starts of it here over the past few years. But I think once people really start to recognize the problems with fiat currencies and that they're being aggressively debased, ultimately you're going to have people that no longer want to accept dollars for goods or services. And thankfully, like we're putting the rails in place for people to be able to do that, right? So like what Square's done, like a company like Parker's company that he works for, Zap right now, that we're putting the infrastructure in place so that that transition can occur. But I do think it's going to actually have to come from people wanting to accept it as opposed to people wanting to pay in it, if that makes sense.
Yeah, you have a lot more incentivized, a lot bigger of an incentive to just accept it as a medium of exchange, because you're like, okay, I anyways want to stack Bitcoin, and so I save on the exchange fee from euro and US dollar, and I just get it directly in my wallet, and so it's a lot more convenient for me. And then obviously once you have it, and once you get your main income also in Bitcoin, and the share gets bigger, then at some point you're like, oh, it would be nice to just spend it from there, because now I have to pay the exchange fee back to US dollar or fiat currencies, and actually becomes nicer to then also spend it if you anyways already get the Bitcoin. That makes a lot of sense. I think this is it's always, I always try to look at incentives, because this is then really showing where people are going. You can dream for whatever you want to dream, but incentives show you what people then actually will do with their money and how it will be developed.
Right.
Really cool. We have an end routine, as you know, on the podcast where the previous guest, or as you might know, has been over a year, where the previous guest is asking a question for the next guest without knowing who the next guest actually is. And the previous guest asked you the question, we kind of already had it a little bit. How do you view the relationship between gold and Bitcoin, as both are sound money to some extent?
Yeah, I think the relationship is effectively gold is analog sound money, and Bitcoin is its digital counterpart. And I think it improves upon a lot of the sort of core monetary properties of gold, being truly finite, being infinitely divisible, portable over the internet. It's the natural evolution of sound money in my mind. And so the opportunity today is that most people don't understand that. They haven't done the work to understand what Bitcoin really is, how it works, why it's resilient and robust. And so that linkage of the analog and digital is still, being formatted and still being digested by market participants and really everyone around the globe. And I think going forward, though, they are going to be perceived as similar, right? Like the underlying investment thesis on why you would own gold is the exact same as why you would own Bitcoin. And I think people just need to effectively get the education, the understanding of how Bitcoin actually works, why it's very different than the broader crypto space. I think that's frankly a lot of what the inertia has been over the past several years, is that it's very easy to conflate Bitcoin with crypto and think of Bitcoin as, levered NASDAQ exposure, when in reality, I view Bitcoin as a risk-off asset similar to gold. I would say the vast majority of people on Earth still view Bitcoin as a risk-on asset. And so you see in these, just even this week, like you had gold spiking, I think over 48, and Bitcoin's kind of going down or sideways. And so there's not the immediate recognition that they are super similar, but, historically you have seen this lagged effect. And I think, it comes back to a function of education, right? Like Bitcoin adoption, generally speaking, is a function of education. As more people understand what it is, how it is digital gold or gold with wings to some extent, like that is going to influence the market and allow people to adopt the asset in a way that feels very similar to why they would adopt gold. The reality on the ground is like that's the opportunity right now. That's why Bitcoin is so asymmetric, because most people don't understand this.
100%, and I think this is great closing words. Thank you so much, Brian, for being on again. Before I let you go, where can people find you on Ramp and all the things that you're doing?
Yeah, you can find me on Twitter at /BTC. You can find OnRamp at OnRamp Bitcoin or onrampbitcoin.com. Reach out to us. Reach out to me if you want to learn more about what we do. I think historically, since we started the business, there's been some perception that we only work with institutions or super high net worth folks. And while we do service pension funds and endowments and public companies, the bulk of our clients today are individuals. And so we've sort of done a renewed marketing push this year around servicing individuals. So if you sign up with OnRamp, accounts for an MiC vault start at $250 a month. With that included is an IRA account. Reach out if you want to learn more about what we offer and how we can help you in your Bitcoin ownership.
Thank you so much, Brian. And also thank you so much for everyone that is watching and listening for joining us today. As always, I'll be back.
Thanks, Robin.
This content is for educational and entertainment purposes only and does not constitute financial advice.